That's why I don't own any stocks. I don't, because I'm an entrepreneur. I don't need to buy stocks because I can create my own assets. I create my own companies. I invest in private companies. These are public companies. As the other day I was at the gym, and this gentleman comes up to me, and he was really proud, He says, I've been a bus driver for the city of Phoenix for 40-something years, and I'm going to retire. And I said, I don't know anything about government employees. And I said, is the government giving you a retirement? So years ago, when I was a kid, before 1974, there was a thing called a defined benefit pension plan. Defined benefit meant they guaranteed you X amount. So my poor dad, if he retired, he lost his pension too, which is this book here, Who Stole My Pension. This book just came out, Who Stole My Pension, because it's going to be one of the biggest problems the world faces, is our pensions have been stolen. And the reason it's in trouble is because when we had defined benefit pension plans, if the government promised my dad $1,000 a month, they had to give him the $1,000 a month. And then something happened in 1974. It was called ERISA. And ERISA stands for Employee Retirement Income Security Act. And the government says income security, they're lying to you. And today it's called the 401k, the IRA, the Roth IRA, a SEP, Kios, and all this stuff. And when it shifted from defined benefit, which is a guaranteed set amount, and even like Ford Motor had defined benefit plans. So if I worked for Ford for, let's say, 30 years, I got a guaranteed payment every month. Then in 74, it shifted to defined contribution. Those are massively different plans, but of course, they don't tell you that in school. So when this gentleman said, I've been driving the bus for 40-something years, he's about my age, and I'm going to retire, I said, oh, do you have a government pension, defined benefit? He says, no, I have a 401k. I don't know if you listen to the Rich Dad program, but we dump all over that 401k because, in my opinion, it's not that it's bad, it's horrible. That's the problem with it, because if the stock market crashes, this bus driver who's about my age gets toasted. He gets wiped out because it's a defined contribution, not a defined benefit. And that's a very, very big difference. He says, don't worry. He says, I know what you're saying, I know the stock market is way up there, so I shifted into safety. I said, ¿Qué pasa? What did you do? He says, I shifted into bonds. I went, oh. Because he drank the Kool-Aid that U.S. Treasuries or bonds are safe. And when I was a kid, that was true, but not anymore because of the change from defined benefit to defined contribution, which took place in 1974. So we have we have a new apprentice at the Rich Dad Company. His name is Spencer. So when we hired him as my apprentice, the first thing his mother said to him was, be sure you get a 401k. Now, after I got finished vomiting, I said, I better say something, because I don't really talk. I talk about it in books and things like this, but never really address my concerns on that. So without financial education, the average employee or, a doctor or a lawyer who has a IRA or a SEP or a Roth IRA or a Kio, they don't know anything about investing. All they're doing is sipping on the Kool-Aid. So I want to show you why that bus driver, a great guy, 40 years on the bus, he says, I moved to safety. So what happens here is the relationship, as you can see this chart here, you have bonds like U.S. Treasuries, and then you have stocks, something that's called equities. So what happened was when Nixon took the dollar off the gold standard in 71, remember 71 was Nixon taking the dollar off the gold standard. 72, Nixon went to China, which opened the door for Walmart shoppers and Amazon. And then all these things started to happen. So the U.S. economy started to sink because the Chinese were producing better products at better prices. And then a guy like Clinton opened the Chinese door to the WTO, the World Trade Organization. So what happened when I was in my 20s, because the economy was stalling, they had to start dropping bond yields. So my numbers are probably off because I don't really like bonds. But let's say back when I was getting into the workforce, you could get 16% on a bond. So if you put $1 million or 100,000, whatever it was, you got 16% on your money. But as the economy slowed, they kept dropping the bond prices. They wanted to drop debt, make it cheaper. Then what happened is that the stock prices higher. So that's macro. That's the relationship between bond prices coming down and stock prices going up. So after 2008, what they call the GFC, the Great Financial Reset or whatever they call it, they had to keep dropping bond prices lower and lower and lower, and it got near zero. So they call it zero bound. So in some countries in Europe, if you have $1 million, you put it in a bank, they charge you money there's no interest in it. So that's why Rich Dad, Poor Dad came out in 1997. I said savers are losers. The reason I said that was interest rates on your savings was going down. And they were printing more and more money on the macro level. And what happened is then these companies like the Fortune 500, they were borrowing cheap money to prop up their stocks. So they were buying back their stocks, which sent the stock price higher. So today, this is April 2021. The stock market is at an all-time high. Bond prices are about, I think the 10 years about 1.5%, so it came up just a little bit. This affects the whole economy. So when that bus driver said to me, he says, don't worry, I got out of stocks, I went into bonds. I said, I hope you like driving the Titanic because you're going to go down with it, And he got so angry at me because he did all the right things that his financial planner told him to do. And in a normal economy, that was smart because when I was a kid, only gamblers were in the stock market. You can ask Jim Records, who wrote Currency Wars and all that. He says Jim and I are about the same vintage. The only people that were in the stock market were gamblers. Everybody else, back in my times in the 60s and 70s, were in bonds because they were really safe. So you could get that. And now it's like this. The problem is for that bus driver is this. If the bond prices go up again because they got too much inflation, I'm not saying it's going to happen. It's either going to inflation or deflation. We don't know. I don't know. But let's say they raise the bond price, stock market crashes, okay? Because the companies like Ford Motor Company, IBM, and those guys, the price of their debt goes higher. They're so deeply in debt because they've been borrowing from, let's say, IBM's treasury, and they've been buying back their stocks so their executives can parachute out with stock options. So the CEOs and the executives of these major corporations in America have been screwing everybody because they were borrowing money from the company to buy back the shares of their stock because the price of money was so cheap. But it drove the stock market to all-time high. So today, of the S&P 500, sort of the benchmark of how good the economy is, of the S&P 500, 100 or 20% of the S&P 500 are zombies. In other words, their debt is so high because their stock price is high, but they kept borrowing money to prop up the stock market. So what you're looking at here is kind of a mini, macro look at the world. So let's say they raise the bond price. Okay, so let's say they go from 1.5% to 3%. 100 companies crash. of the Fortune 500, they crash because they can't make enough money to pay off the debt they borrowed. So their CEOs and executive vice presidents and all the investors can parachute out, screwing the stock people who invest in the stock market. That's why I don't own any stocks. I don't, because I'm an entrepreneur. I don't need to buy stocks because I can create my own assets. I can create my own companies. I invest in private companies. These are public companies.